What's up, everybody? This is Sunko, the Korean Bro. Today is 2024, April 2nd. Um, it's been quite a while since I did YouTube last time because of um, some problems with microphone and my camera. Uh, Something was wrong with my camera and microphone, and it been giving me a lot of trouble to figure out how to solve it. And now it's all done, so I'm back. Okay, let's see what articles we have tonight and see and look for interesting companies. Okay, a once in a generation investment opportunity, one high yield dividend stock to buy now and hold forever. This April, Enbridge is working to close a once in a generation acquisition opportunity. The deals will significantly enhance its cash flow and growth profile. They hope give it the fuel to continue increasing its high yielding dividend and produce strong total returns. Let's see what this company is. Enbridge has been an exceptional investment over the decades. The Canadian pipeline and utility operator has delivered more than an 11% compound annual total return over the past 20 years. It has outpaced the S&P 500 and its nearly 10% annualized total return and its peers in the utility and midstream sectors with about 8% average annual total returns. The energy infrastructure company could produce even higher total returns in the coming years. One factor fueling that fuel it the view is its ability to capture a once in a generation acquisition opportunity that it will close in phases this year. The deal will enhance its operations and growth profile, giving it more fuel to increase its 7.5% yielding dividend. Snaring a once in a generation opportunity. Last September, Enbridge agreed to buy three natural gas utilities from Dominion for $14 billion. The transaction will create North America's largest natural gas utility platform with 7 million customers. It's paying a very reasonable price for utilities at about 1.3 times their enterprise value to rate base and 16.5 times price earnings. Adding natural gas utilities of this scale and quality at a historically attractive multiple is once in a generation opportunity, stated CEO Greg Abel in the press release unveiling the transaction. He further noted that Enbridge expects the deal to be accretive to its distributable cash flow per share in the first year of full ownership, which should increase over time, powered by their strong growth profiles. Okay, so Enbridge has something to do with energy. Okay, the Canadian pipeline and utility operator, Canadian pipeline and utility operator, okay, has delivered more than an 11% compound annual total return over the past 20 years. Okay, this company knows how to gain profit, mm, and it's been gaining profit uh, over the past 20 years. Ready stock. Beyond Meat is growing internationally, but not in its biggest market. Investors should be careful about buying the stock today. The plant-based meat specialist is going through tough times. Investors have a chance to buy Beyond Meat stock at close to fire sale prices these days. If there is no shortage of reasons for this deep discount, which has shares trading at about half of their recent highs, the plant-based meat specialist was rocked by slumping demand following the pandemic era sales spike. Consumers in the past year haven't been motivated by big price cuts on its meat substitute products either. Sales are sinking, losses are mounting. They might not sound like the recipe for positive shareholder returns from here. However, Beyond Meat is seeing growth in some important markets outside of the core US segment. Inventory is down too. That's good news for a company with unsold vegan food stacking up in the warehouses over the last 2 years. Getting the inventories down to a more manageable level should make the whole business more efficient. And management is preparing an aggressive restructuring program that could put the company back on a path to profitability starting later in 2024. The current share price reflects lots of pessimism about the business. Against that backdrop, let's look at whether Beyond Meat stock might be a good buy while it trades about 50% below its 52-week highs. Unappetizing results. There hasn't been much for investors to celebrate in Beyond Meat's last few quarterly earnings updates. Sure, the pace of sales declines has slowed in recent months, yet revenue still dropped 18% in fiscal 2023. Consumers aren't snapping up its meat substitute products, and grocery stores and restaurant chains aren't committing to as much volume either. These sales channels were down 34% and 27% in the US market last year, respectively. Okay, I get it. So this company sells meat substitute products. Uh, Although it gained a lot of attention in recent years, its sales went down dramatically. Um, so it's not as much as what people had expected. Um, People were thinking it would gain popularity, but in fact, its sales went down a lot. So business wise, it's not as good as what people think it is. Mm. So okay, here we go. Leave it on the shelf. There's just too much risk around this business for most investors to feel comfortable with Beyond Meat stock in their portfolios, though. The company isn't even profitable on a gross basis. Mm. After all, in other words, the cost of products sold exceeds the incoming revenues, and that's before allocating budgets to things like sales and marketing, research and development, or management salaries. Yes, that's partly because of one-time charges related to inventory write-downs. But the company also had to heavily discount its products to keep merchandise moving through the system. It was forced to discontinue other items, like jerky product that simply cost too much to manufacture. Investors should watch the gross profit margin for signs that Beyond Meat is moving back toward a sustainable business model. But the more immediate worry is cash flow. The company has been burning through cash for 2 fiscal years, will likely post another year of red ink in 2025 as its restructuring plan ramps up. You might want to follow the stock as details about that rebound plan emerge over the next few quarters. Beyond Meat is priced cheaply today because of its awful earnings prospects and continuing losses. Aggressive restructuring moves might send the shares higher if investors are convinced that they'll put the company back on a profitable track. Until then, you should leave this discounted stock on the shelf. One growth stock down 29% to buy right now. Okay. The market for digital entertainment should grow for many more years. If you're a growth investor, you're likely struggling to find compelling deals in the market. The S&P 500 is up 10% so far in 2024 after having soared last year, and the rally has been even more pronounced in the high growth tech space. Okay, I get it. So many stocks that had been pummeled in 2022 are rebounding now. The Wall Street's feeling better about the prospects for the economy, interest rate trends. But Roku has been left out of that recovery. The streaming stock is down nearly 30% year to date. Don't let that slump scare you away from this attractive business. Sure, Roku isn't nearly as established as Netflix, which is generating ample cash flow and excellent profits right now. In constant, Roku recently announced the second straight year of net losses in 2023. But investors should still consider owning Roku stock following its recent pullback. Here's why. Great engagement. Roku has a unique operating model. They're still in the process of building up its monetization strength. The main challenge is that the company gets most of its earnings from advertising spending, Various streaming video rivals like Netflix and Disney Plus focus more on paid subscriptions. Unique operating model that's still in the process of building up its monetization strength. The main challenge is that the company gets most of its earnings from advertising spending, where your streaming video rivals on Netflix and Disney Plus focus more on paid subscriptions. The former approach hasn't been profitable lately because digital advertising rates slumped through most of the past year. The Roku is having no trouble on the engagement front. Streaming hours rose 20% in 2023 to cross 100 billion. The company added 10 million active users last year and now has 80 million accounts. Okay, so it wasn't easy to monetize the expanding audience last year, but it's likely just a temporary challenge. Zoom out and you will see lots of room for growth as more TV viewing tilts away from traditional broadcasting and towards streaming. Roku's average streaming time per day was 4.1 last year, for example, up from 3.8 hours in 2022. But the average daily TV time in the traditional broadcasting world is nearly 8 hours. So, growth over profits. Roku has decided to prioritize growth over short-term profits, and Wall Street was disappointed to see that the streamer can't achieve both goals right now. Operating losses expanded to a painful $800 million last year from $530 million in 2022. The metric might be enough to keep many investors away from this growth stock. Look beyond the headline profit metrics, though. You will see encouraging signs of an earnings rebound on the way. Roku returned to positive free cash flow last year, and management is forecasting positive earnings on an adjusted basis in 2024 as the company works to produce positive GAAP results in the coming years. We plan to increase revenue and free cash flow, achieve profitability over time, executives said in a recent shareholders letter. Looking ahead, cautious investors might want to wait for signs of concrete progress on the profit front before buying the stock. The next few quarters could be volatile, with sales projected to rise about 12%, according to most Wall Street pros. If you believe Roku will find ways to monetize its growing user base, you could see some great returns from buying the stocks now while pessimism elevated. Shares are valued at less than 3 times sales compared to Netflix price sales ratio of 8. It might be several years before Roku can meaningfully close their valuation gap, but patient investors should be happy to watch that story play out, assuming Roku can find ways to capitalize on its growing audience base. So what else do we have? Verdicts Pharmaceuticals. You'll regret not buying these magnificent 7 stocks. Okay. First things first, Amazon and Google. Okay, let's see about that. Alphabet CEO Sundar Pichai describes the company as 7 years into its journey as an AI-first company this year. A poor debut for its new large language model Gemini created that doubt over its potential in the industry. However, the company remains a behemoth in tech, with significant cash reserves that will likely see the company retain its dominance and eventually catch up to its AI rivals. In-house brands like Android, YouTube, Chrome, and Google have granted Alphabet a powerful position in tech. These brands attract billions of users and have helped the company's annual revenue rise 90% in the last 5 years, with operating income up 135%. Meanwhile, Alphabet's many products create almost endless opportunities to boost its business with AI. So improving Gemini could see Alphabet offer more effective advertising, develop a search experience closer to OpenAI's ChatGPT, better analyze viewing trends on YouTube, and expand its AI cloud services on Google Cloud. Improving Gemini could see Alphabet offer more effective advertising, develop a search experience closer to OpenAI's ChatGPT, effective advertising, search experience closer, OpenAI's ChatGPT, better analyze viewing trends on YouTube, expands its AI cloud services on Google Cloud. The chart above shows Alphabet stock is trading at significantly better value than Nvidia's, with a far lower for the price to earnings ratio and the price free cash flow ratio. These are helpful valuation metrics as they consider a company's financial health. The lower the figure, the better the value. Additionally, Alphabet's free cash flow of nearly $70 billion compared to Nvidia's $27 billion suggests it's potentially better equipped to keep investing in its business and overcome current headwinds. The Google company may have hit a few roadblocks this year, but that's precisely why now is the perfect time to make long-term investment in stock. The Magnificent Seven company has an exciting outlook for the coming years and trades at a bargain compared to Nvidia. Okay, now here we have Amazon. Okay, oh, Amazon delivered impressive growth in 2023 after facing declines from an economic downturn in 2022. In fiscal 2023, Amazon revenue rose 12% year over year, with operating income more than tripling to $37 million. A solid recovery in its e-commerce earnings over the last year has seen the company's free cash flow soar 94% to surpass $32 billion. This indicates it has the financial resources to continue expanding and managing possible hurdles. Amazon has come a long way since starting as an online book retailer out of Seattle almost 30 years ago. The tech giant has expanded into multiple industries from becoming a titan of e-commerce to leading the cloud market, developing space satellites, and venturing into grocery, gaming, consumer tech, and more. But all eyes have been on Amazon's AI efforts over the last year. And as the operator of the world's biggest cloud service, Amazon Web Services, the company has the potential to leverage its massive cloud data centers and steer the generative AI market. In 2023, AWS responded to increase the demand for AI services by introducing a variety of new tools. Amazon is even using AI to boost its retail site, announced an AI shopping assistant Ruffles ahead of its latest earnings release. Amazon is moving to become a major threat in AI over the long term, but also has a lucrative retail business that makes its stock too good to pass up. Uh, Moreover, the table above indicates Nvidia's earnings could reach $36 per share over the next two fiscal years, while Amazon's may achieve $7 per share. On the surface, Nvidia looks like a clear winner. However, multiplying these figures by the company 4 PE ratios yields stock price of $1,309 for Nvidia and $301 for Amazon. Considering their current positions, these projections would see Nvidia stock rise 45% by fiscal 2026 and Amazon's increase by 67%. Alongside the lucrative e-commerce business and expanding position, then yeah, Amazon is a magnificent seven stock worth considering over Nvidia right now. You might be surprised which Magnificent Seven stock analysts like the most. Aren't very bullish about several Magnificent Seven stocks. However, Wall Street thinks that one member of the group has the most upside potential over the next 12 months. This optimistic outlook could be warranted because of a potential upcoming catalyst. Hmm. Okay. Uh, Last but not least, I'm going to read one last article and I'll put an end to YouTube. Okay. Okay. Let's see about that. Forget the Magnificent Seven. Want to take stock to buy instead. Okay. The massive size of the companies, the Magnificent Seven limits their potential upside. And smaller stocks like Shopify offer investors broader long-term prospects. By investing earlier in its growth story, patient investors can outperform today's Magnificent Seven. This growth stock looks poised to do even better. Investing in Magnificent Seven stocks have proven very profitable. Many of these stocks, which include notable growth companies like Alphabet, Meta Platforms, Nvidia, have seen their shares price put up triple-digit gains over the last past several years. While there's still upside for these market giants, investors can see the biggest gains by investing in the next Magnificent Seven stock. Look no further, here's Shopify. This could be the next $1 trillion stock. Okay. Every Magnificent Seven company has at one point seen its market capitalization clear $1 trillion. It's worth asking how they achieved such a lofty valuation. There are three main characteristics that nearly all of the Magnificent Seven share. First, they're all exposed to massive growth markets. And by massive, I mean truly massive. You can't become $1 trillion business by focusing on the $50 billion or if even a $500 billion market. To grow this large, a business must target multi-trillion-dollar opportunities. On this first task, Shopify passes with flying colors. It operates an e-commerce platform that allows anyone to sell online in just minutes. Millions of small businesses use its platform every day to conduct business online. Large enterprises use the platform as well, including Glossier, Molson Coors, Nestle, and Metal. How big is this e-commerce market? This year, billions of online shoppers are expected to spend $3.2 trillion globally. Is Shopify targeting an opportunity large enough to become part of the Magnificent Seven? Absolutely. The second characteristic most of the Magnificent Seven share is that they are highly profitable. Many of these companies, for example, focus on software. While expensive to initially build and roll out, software businesses can become very profitable as they scale. That's because adding another user to the existing system costs software business relatively little. Companies that produce physical products, by comparison, must invest in additional facilities and labor to expand output. When looking at the gross profit margins, Shopify's 50% gross margin is superior to that of the companies that focus on physical products like Apple and Tesla. But below are the softer businesses like Meta and Alphabet. While Shopify's gross margin doesn't lead the Magnificent Seven, it's certainly high enough to fall within the group. The final characteristic that Shopify shares with Magnificent Seven is its ability to maintain high growth rates for extended periods of time. While there have been steep fluctuations along the way, most Magnificent Seven companies have been able to deliver double-digit revenue growth rates for years and years. As you can see below, Shopify has consistently reported growth near the top of the pack. That's largely due to its smaller size, but that's exactly the point. So Shopify stock has room to grow. Like many of the Magnificent Seven stock, Shopify is targeting a multi-trillion-dollar opportunity. It also sells a highly profitable, highly scalable product. It has a proven history of maintaining high growth rates for years at a time. But here's the key difference: Shopify is much smaller than most Magnificent Seven stocks. With a market cap of about $100 million, Shopify has a huge runway of growth ahead of it. The e-commerce market will only continue to grow. The next decade, and Shopify is investing its business to take more market share. Research and development expenses have been climbing in recent years, with 2023 hitting nearly 25% of revenue. Investing in the Magnificent Seven is still a promising strategy, but if you want the biggest gains, you have to find a business of their caliber before they reach critical mass. Right now, Shopify looks like a Magnificent Seven style in making, and investing now provides most potential for long-term growth. Okay, I read it really fast because I wanted to grasp every point it tries to make in this article. So it's all done, and I'll be back tomorrow. I'll see you guys and have a good night. Okay, bye bye.